Trade is a fundamental part of economics. If it wasn't for trade, it would be hard to get the things that we want. We can't produce everything on our own, although people have tried. And in so doing, they've found that it's very expensive to produce everything that you want, not just in terms of money spent, but in terms of time given up. So instead, we trade. We get things from people who specialize in the production of other goods, whether it's your contact lenses, whether it is your computer, whether it's your car, whether it's gasoline. We buy them from people who specialize in the production. One of the advantages of the specialization is that we can get products that we want at a lower price. Trade, when extrapolated to the macro level, works in a very similar fashion to trade at the micro level. In a country that doesn't trade, we have domestic producers and domestic consumers, and they trade with each other, and the price is set by the intersection of demand and supply. By domestic, we simply mean that you're not trading with anybody from another country. It's all trade that's done locally or within the borders of your country. Now, when trade happens at the international level, countries assume different positions. There is the producer, or typically we would call them the exporter, and there's the consumer, whom we call the importer. The producer makes the goods and sells them to the other country, who imports them, and their consumers and their citizens can buy those products made somewhere else. And we all buy things made somewhere else. We all have things that are made in China, or made in Hong Kong, or made in Britain, or made in Mexico, or made in Canada. We all own things that have been made somewhere else. When we look at this from a more formal model perspective, we see that the trade benefits both countries. Regardless of what you think of the trade on the surface, the trade is going to make both countries better off in terms of added surplus. In other words, there are people in the scope of the trade who are going to be made better off by increasing the value that they receive from the trade. So for example, let's say we have two countries. Let's say we have the United States and Brazil. And let's say that Brazil wants to sell coffee to the United States, and the United States wants to buy coffee. Well, in this case, Brazil would be the exporter, and the United States would be the importer. Now, things are going to be a little bit different in these two countries once trade is allowed. The price that is set in the two markets, we're going to assume will be the same price regardless of which country you live in. And we're going to refer to that as the world price. The world price in the exporting country is always going to be higher than the price domestically. And the reason for this is that the coffee producers need a financial incentive to sell their product overseas, sell it to the United States, and that financial incentive comes in the form of a higher price. The reason they need that incentive is because they need to be compensated for the increased production that they're about to engage in. Now, for the United States, the importing country, the price that people in that country will pay will be always lower than the domestic market price. That's one of the reasons we trade, so we can get things at a cheaper price. And in this case, we wouldn't trade with Brazil if we had to pay more for coffee than we would have to pay if we produced it on our own. So in this case, the price will be below the market equilibrium. Now, this sounds great for both countries. It sounds like the producers in Brazil are getting a higher price, and they are, and the consumers in the United States are getting a lower price, or paying a lower price, and they are. So what's the problem? Well, the problem depends on who you are and in which country you find yourself. Let's take a look at Brazil again. If the price is higher once the world price is instituted, that means that consumers in Brazil are paying more. Now, they don't like that. And so at the higher prices, the quantity demanded falls, and the consumer surplus falls as well. Now, at that higher price, Brazilian producers are encouraged to produce more, but they can't sell that extra production in Brazil. They need to sell it somewhere else. And that is where the United States steps in. That extra production, which we would normally call a production surplus, can now be sold to another country. So our exports are equal to the distance between the demand curve and the supply curve. Now, the United States looks at this a little bit differently. In the United States, the consumers are paying a lower price, and so they're very happy about this, and their consumer surplus increases. But the producers aren't so happy. Their producer surplus decreases, and at the low price, the quantity that they're willing and able to sell would go down. Now, normally, that would cause a shortage because there are people who want to buy the product at a lower price who can't find it. In steps Brazil. Brazil has all this extra coffee. The United States has all this excess demand. There are shortages in the United States, and so Brazil can step in and fill that shortage, and the distance between the supply curve and the demand curve in the United States is what forms our imports. Now, there's one other thing about this. The producers in the United States aren't real thrilled about these lower prices, and they may go to their political representatives and say, hey, we don't like this. We're losing money. We're having to lay people off. Perhaps you ought to reconsider the way this trade is allowed, the way this trade is happening. And so perhaps a tariff would get put in place. A tariff is a tax, and a tax raises the price of the product. And that tariff is going to raise the world price paid by the domestic consumer in the United States, and it's going to raise that price closer to the price that existed before trade. Now, by raising that price, that reduces the distance between the demand and the supply curves, which reduces the amount that we import. It also reduces the consumer surplus. It increases the producer surplus, but it reduces the gains that existed from trade. Let's look at that gain from trade real quickly. The gain from trade is this additional consumer surplus. Now, some of that additional consumer surplus comes at the expense of the domestic producer, but some of it is created as a result of more trade. This triangle here illustrates that. When we put a tariff in place, that raises the price and reduces the size of the gains for the economy. In the importing country, the gains to the consumers outweigh the losses to the producers. So as a whole, the country's made better off. Once we put that tariff in place, we reduce those additional gains. In Brazil, we have a similar story, except for it's the gains for the producer that outweigh the losses for the consumer. If a tariff is put in place, that's going to move the world price closer to the pre-trade price. It's going to reduce the gains to the producer and reduce the losses to the consumer, but it shrinks the overall macroeconomy. So, when we put tariffs in place, we reduce gains from trade. Trade's a very valuable thing. It helps us to deal with the economic problem pretty well. But if we allow barriers to trade to get put in place, it reduces those gains, as we see in the model.